Hello everyone, I'm Sebastian Y and this is Foundations of Economics. In this video, we're going to talk about saving, investment, and the financial system. Previously, we discussed the concept of investment as expenditure on physical capital that is used in the production of goods and services. Investment is an important component of GDP growth. The more investment there is, the higher the standard of living will be in the future because workers will have more physical capital to use in production. Investment requires funds. Households may also wish to save part of their income for the future instead of using it for consumption now. The funds required to make investments come from other people's savings. A country's financial institutions provide the mechanisms to match up saving with investment. Financial markets provide ways for one person who wants to save to directly supply funds to someone who wants to borrow, and then use those funds to invest. The two main financial markets are the bond market and the stock market. Funding investment through the sale of bonds is called debt finance, and funding investment through the sale of stock is called equity finance. Before we move on, I want to point out that buying stocks and bonds are colloquially called investments, but in economics, we consider those saving. The term investment in economics is reserved for purchasing more physical capital. It's the sellers of stocks and bonds who are using those sales to raise money who are doing the investing because they're going to use those funds to purchase capital. Let's start with bonds. The seller of a bond promises to pay back the amount borrowed, known as the principal, plus interest at an agreed upon date of maturity. Bonds are characterized by their term and risk. The term is the amount of time the buyer must wait until the bond matures. Once the bond matures, the borrower is required to pay back the loan plus interest. Risk is the probability that the borrower will default and fail to pay back the loan specified by the bond. Bond buyers prefer shorter terms because they want to get their money back faster, and lower risk because they don't want to be defaulted on. As such, the buyers of bonds require higher interest rates to compensate for either longer terms or higher levels of risk. Generally, the government's bonds are considered the least risky and therefore have relatively low interest rates. In the US, treasury bonds are an example of this. The riskiest bonds, known as junk bonds, generally have the highest interest rates. Unlike bonds, sale of stock makes the buyer a part owner of a firm. This gives the stockholder a share of any future profit that the firm might make. This potential payoff is much different than a bond, which has a fixed interest rate. Other than the risk of defaulting, bonds don't have any relationship with the future performance of the firm. The return on a stock purchase, though, is directly tied to the future performance of the firm. This makes buying stock a riskier way to save money, but one with potentially higher returns. Stock markets work similarly to the markets for goods and services that we've discussed earlier in the course, in that there is a supply curve and a demand curve. The demand curve for a particular stock is determined by how potential buyers view the future profitability of that stock. The next two financial institutions we will look at are types of financial intermediaries, which provide ways for savers to indirectly provide funds to borrowers. Banks are the most familiar form of financial intermediary. Banks play an important role in saving and investment because it is generally difficult for small firms to raise money for investment through the bond and stock markets. A small local business generally does not have access to those financial markets. Instead, these firms can take a loan from a bank, which charges them interest for the loan. The funds that banks use to provide loans come from the people who use the bank to save money. Banks incentivize savings by paying interest on savings accounts. By charging a higher interest rate on loans than the interest rates they pay on saving, they can make a profit. Banks are also an important component of the monetary system, which we will discuss later on in the course. Our final financial institution we'll discuss here are mutual funds. Mutual funds sell shares to people who want to save and use the funds to purchase a portfolio of stocks and bonds. In exchange, they charge those people who are saving money a fee. A significant advantage provided by a mutual fund as opposed to buying an individual stock or bond is that savings are diversified across a variety of different assets. If a person saves all their money by buying stocks in a single company, and that company does poorly, they will end up losing a lot of money. If they instead spread out those savings using a mutual fund, if one of the companies within the portfolio does poorly, it has relatively little impact. Mutual funds can be either index funds, which buy all the stocks in a given stock index, such as the S&P 500, or actively managed. Managed funds are run by managers who watch markets carefully and adjust the portfolio in an attempt to maximize returns. Economists tend to be skeptical of managed funds because even the best managers find it difficult to beat the market by outperforming index funds. Now that we've summarized the institutions that facilitate saving and borrowing, let's discuss how these concepts fit into the economy as a whole. Let's return to our equation for the GDP of a country. GDP, which is Y, equals consumption plus investment plus government spending plus net exports. For simplicity, we are going to consider a closed economy, meaning that it does not import and does not export. That means net exports are going to be zero, and so we're just going to drop those out of the equation. Let's rearrange this equation just a little bit and subtract consumption and government spending from both sides. That gives us Y minus C minus G equals I. Let's examine this left-hand side. Y, the GDP, is the total national income. Once we subtract off what is consumed by private citizens, that's C, and the government, that's G, we are left with national saving, which we are going to denote as S. And so that leaves us with S equals I. That is, saving equals investment. All the funds that people save through the financial institutions we discussed end up getting borrowed by someone else to use for an investment. Let's take our national saving equation, S equals Y minus C minus G, and introduce taxes to this. We're going to take this first part here and subtract taxes from that. This is going to give us Y minus T minus C. This part is what we call private saving. This is the total amount of income that private citizens have left over once they have already spent their money on consumption and paid their taxes. But those taxes don't just disappear. They go to the government, who then spends the amount G. This part of the equation is public saving. When we take the amount of taxes and subtract off the amount of government spending, whatever is left over is the amount that the government saves. Digging into that last part a little bit more, if T minus G equals 0, that is, taxes are equal to government spending, then that is what we call a balanced budget. The government is taking in exactly the same amount that it's spending. If T minus G is greater than 0, then we have a government budget surplus. They're taking in more in taxes than they're spending. Finally, if T minus G is negative, then there is a budget deficit. This means the government is spending more than it's taking in taxes. Historically, the United States has had a budget deficit every year since 2002. When there's a budget deficit, then the government needs to take loans to make up the difference, and we will talk about that later on. We will now develop a model for the market for loanable funds. People who want to save go to this market to deposit funds, and those who want to invest go to the market for loanable funds to borrow funds. For simplicity, we are going to assume that an economy has just one market for loanable funds. Of course, in real life, any economy has lots of different markets for loanable funds, corresponding with different ways to save and borrow. This means we're going to have a separate stock market, a separate bond market, and so on. But just for simplicity, we're just going to think about an economy with a single market for loanable funds. The market for loanable funds functions similarly to any market that we've discussed so far. Instead of a traditional price P, the price in the market for loanable funds is the interest rate, which we are going to denote as R. We are going to express interest rates as decimals. So for example, a 10% interest rate is going to be R equals 0.1. As with any market, the market for loanable funds has a supply curve and a demand curve. Saving constitutes the supply of loanable funds. As interest rates rise, more people are willing to save money, so just like any market, we have the law of supply. Investment constitutes the demand for loanable funds. As interest rates rise, fewer people are willing to invest because of the higher interest rates they would have to pay on loans. So we have the law of demand. We're going to use both functions and graphs to describe our market for loanable funds. Let's look at an example. Suppose our saving function, that's going to be the supply function in this market, is negative 200 plus 10,000 R. And our investment function, that's our demand, is 1,000 minus 10,000 R. In equilibrium, we have to have saving equals investment, and so I'm going to set negative 200 plus 10,000 R equal to 1,000 minus 10,000 R, and then do the algebra. I'll add 200 to both sides, and that's going to give me 1,200 over here, and add 10,000 R to both sides, and that's going to give me 20,000 R over here, and then divide both sides by 20,000 to give us an equilibrium interest rate of 0.06, which is 6%. To get the equilibrium quantity of loanable funds, which is both saving and investment, we can then plug our interest rate back into either of our curves. If we plug it into the saving curve, we get negative 200 plus 10,000 times 0.06. That's going to be negative 200 plus 600, which is 400. And if we plug it into the investment function, we get 1,000 minus 10,000 times 0.06, which is 1,000 minus 600, and so that's also 400. Let's go ahead and graph these. We'll do the investment curve first. The intercept on the loanable funds axis is going to be 1,000. And as always, to figure out the interest rate intercept here, we need to figure out what would the interest rate have to be to drop investment down to 0. And in this case, all we need to do is take 1,000 and divide it by 10,000, and that's going to be 0.1. I'll draw that graph in. And label that with an I for investment. For the saving curve, the interest rate intercept is going to be 200 divided by 10,000, which is 0.02. That is, 200 is 2% of 10,000. It's going to have the same slope as our investment curve, but we can also notice that these two curves are going to have to cross at our equilibrium, which is 6% and 400 quantity of loanable funds, and so the saving curve is going to have to look something like this. Label that with an S for saving, or supply if you like. And then I'm just going to mark out our equilibrium of 6% interest and 400 loanable funds. Now that we've developed a simple model for the market for loanable funds, we can use that model to investigate how different government policies can affect financial markets. We're going to use the same general process of comparative statics that we did back when we looked at markets for goods and services. We'll analyze a policy, figure out which curve is affected, draw the shift of that curve on the graph, and figure out what the new equilibrium is and compare that back with the original equilibrium that we had. As we discussed previously, investment in physical capital is a major driver of economic growth and increases in the standard of living. We've looked at China as an example of that. As such, the government may have an interest in encouraging investment so as to grow the economy. They can do this by increasing the equilibrium quantity of loanable funds. To increase the equilibrium quantity in any market, either the supply curve or demand curve needs to shift to the right. In the market for loanable funds, that translates to shifting either the saving or investment curve to the right. Let's first look at a policy to incentivize saving. The government can do this by offering tax breaks to people who save money. In the United States, individual retirement accounts, or IRAs, were introduced in 1974 as a way to do this. If taxes are reduced on saved income, saving becomes more valuable at any given interest rate. This is going to shift our saving curve to the right. I'm going to draw in a new saving curve. We'll call that S prime. We can now compare the equilibrium that we had before the policy change to the outcome after the policy change. we can see that the equilibrium interest rate goes down, but the quantity of loanable funds goes up. This is going to increase both saving and investment, which will result in more long-term economic growth. Next, let's consider a policy to incentivize investment. The government can do this by giving tax breaks to firms that engage in investment in physical capital, such as building a new factory. This essentially lowers the cost of taking a loan to make an investment, and so that's going to make investment a more attractive option at any given interest rate. And so that's going to shift our investment curve to the right. So I'm going to draw in a new investment curve. I'll call that I prime. And then we can compare the original equilibrium with the new one. The effect of this policy is going to increase the equilibrium interest rate, and it's also going to increase the quantity of loanable funds, and therefore increase both saving and investment. The last thing I want to talk about here is how a government's budget, whether a deficit or a surplus, can affect the market for loanable funds. Let's recall the national saving equation, which is S equals Y minus T minus C, that's our private saving, plus T minus G, our public saving. If government spending increases while taxes remain the same, to the point where G exceeds T, we are running a budget deficit. Since total saving is the sum of private saving and public saving, this increase in G will decrease public saving. As that is a component of national saving, that is going to shift our saving curve to the left. If we sketch in a new saving curve, we can compare the equilibria from before and after. We can see that the interest rate goes up and the quantity of loanable funds goes down. Note that since the government is not involved in private investment, nor have the incentives to invest been changed here, the investment curve remains the same. What we learn from this is that when government spending increases, it decreases the amount of loanable funds available for private investment. This effect is known as crowding out. The lowered investment can then decrease the rate of economic growth in the long run. Going the other direction, an increase in public saving will shift the saving curve to the right, which will increase investment and increase economic growth. When the government runs a deficit, it must borrow to make up the difference. This contributes to government debt. When the government runs a surplus, it can pay off some of that debt. Budget deficits typically increase when current events require increases in government spending. Wars are typically a major cause of this. The budget deficit increased greatly during the Civil War, World War I, and World War II. But policies designed to combat recessions also have a similar effect. These are times when the government needs to spend more money, but also does not want to raise taxes. Tax cuts not accompanied by reduced spending can also run up the deficit, and this is essentially what happened in the 1980s under Ronald Reagan. This also contributes to an increased government debt. In this video, we have talked about the relationship between saving and investment and how those things come together in the market for loanable funds through the country's financial institutions. If you have any questions, feel free to let me know. Thanks for watching.